Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, November 19th. Wednesday marked an ugly session on Wall Street, with the S&P 500 and Nasdaq tumbling to their lowest levels in 5 years and the Dow dropping to a 5-year closing low. Concerns over the fate of U.S. automakers, disappointing economic data, a dour outlook from the Fed, and the market's inability to hold its lows fueled the selling interest. The major indices ended the session at their worst levels on above-average volume. The Dow, Nasdaq, and S&P 500 fell 5.1%, 6.5%, and 6.1% respectively. October CPI fell by the largest amount on record, which is good news in terms of the inflation outlook, but also reflects the weakness of the economy. Specifically, CPI fell 1% month over month as energy prices plummeted 8.6%. Prices also declined outside of energy, indicating weak demand. Core CPI fell 0.1% as used car prices dropped 2.4% and apparel prices fell 1%. The latest new residential construction data fell to the lowest levels on record and provided another weak point for fourth quarter GDP calculations. October housing starts declined 4.5% month over month to a seasonally adjusted annual rate of 791,000 units, which was slightly higher than the consensus estimate of 780,000. Building permits dropped 12% to a seasonally adjusted annual rate of 708,000, which was worse than the consensus estimate of 774,000. The Federal Reserve's 2008 and 2009 projections, released today in the FOMC minutes, mirrored the latest economic data, with the Fed reducing forecasts for GDP growth and inflation. For 2008, the Fed expects the economy will grow between 0.0% and 0.3%, down sharply from its previous forecast of 1% to 1.6%. The 2009 forecast now calls for growth between minus 0.2% and 1.1%, down from the previous forecast of up 2% to 2.8%. The Fed also raised its unemployment rate forecast. The minutes hinted at the likelihood of further monetary easing as some FOMC members saw potential for further rate cuts. Although weakness was broad-based with losses posted by all 10 sectors and 492 of the 500 S&P 500 components, the financial sector got hit the hardest with a decline of 11.5%. Citigroup tumbled 23% to its lowest level since 1995. Citi said it will buy the remaining $17.4 billion in structured investment vehicles it advised. Automakers, down 21.2%, got clipped as executives from General Motors, Ford, and Chrysler and the head of the UAW testified before the House Financial Services Committee in an attempt to secure a government loan. There were plenty of opponents in the House, which was similar to views that were expressed by Senate Banking Committee members yesterday. GM CEO said on CNBC that the company is doing everything that it can to avoid bankruptcy, as he sees a high risk that a Chapter 11 filing, which calls for restructuring, could turn into a Chapter 7 filing, which calls for liquidation. Reports that Toyota Motor is going to cut North American production also weighed on automakers. A risk-aversion trade lifted treasuries, with the 30-year bond rallying 3 points to yield 3.94%, marking the lowest yield since the 30-year bond was introduced in 1977. The 10-year note rose 44 ticks to send its yield down to 3.36%. In commodity trading, crude prices fell 2.4% to $53.10 per barrel. The government's weekly energy inventory showed a larger-than-expected build in crude and gasoline stockpiles, indicating decreased demand. I'm Pat O'Hare for Briefing.com. Thanks for listening.